The declining balance method for depreciation is a type of accelerated depreciation that takes larger amounts of depreciation expense in the earlier years of an asset. Let's say that a company purchases a piece of equipment for $3,000 and applies the declining balance method for depreciation. What is the depreciation schedule? To do this, we must know three things: the purchase cost of the equipment or asset, the useful life of the equipment or asset, and the residual or salvage value of the asset. Salvage value is the amount the company expects to receive at the end of the useful life of the equipment or asset. For our example, the useful life is 5 years and the salvage value is $500. The formula for depreciation expense for the declining balance method is depreciation expense each year equals the book value of the equipment or asset at the beginning of the year times the depreciation rate. In order to use this formula, we must calculate the depreciation rate. And the formula to calculate the depreciation rate is depreciation rate equals 100% divided by the years of useful life times the depreciation factor. The depreciation factor is often 1.5, 1.75, 2, or sometimes even 3. And this factor is a multiplier of the straight-line depreciation rate. A factor of 2 is most commonly used, and when it is used, it's called the double declining method for depreciation. For our example, we're going to use a factor of 2. So, plugging that in, we have depreciation rate equals 100% divided by 5, the useful life of the asset, times 2. And this calculates to 40%. So our depreciation expense formula is depreciation expense each year equals the book value of the equipment or asset at the beginning of the year times 40%, or 0.40. Now we have what we need to calculate the yearly depreciation expense, and we can create a depreciation schedule. We're going to put 7 columns in it: end of year, original cost of asset, accumulated depreciation at beginning of year, book value at beginning of year, depreciation expense for year, accumulated depreciation at end of year, and the book value at end of year. And one note about book value: the value in this column cannot go below the salvage value of the asset, which in this case is $500. And this also means that the accumulated depreciation must not be greater than $2,500. For this method, it's important to remember this. We start with end of year 1, and for column 2, cost of asset, this will always be the original cost of the asset, so we can put $3,000 in there. The accumulated depreciation at the beginning of year 1 will be $0, and the book value at the beginning of year 1 will be the $3,000 cost of the asset. For the depreciation expense for year 1, we use our formula of depreciation expense each year equals the book value of the equipment or asset at the beginning of the year times the depreciation rate of 40%, or 0.40. Plugging in, we have $3,000 times 0.40, and this calculates to $1,200. So we put that in the expense column. For the 6th column, accumulated depreciation at end of year, this is the total amount of depreciation accumulated at the end of each year. So at the end of year 1, the total amount of depreciation will be the $1,200 we just calculated. Now for the last column, the book value at end of year. This is the original cost of the asset minus the accumulated depreciation at the end of the year. So the book value at the end of year 1 will be the original cost of $3,000 minus the accumulated depreciation at end of year 1, $1,200, which equals $1,800. And year 1 is complete. Now for end of year 2. For column 2, again, this is the $3,000 original cost of the asset. The accumulated depreciation at the beginning of year 2 is the same as the accumulated depreciation at the end of year 1, which is $1,200. The book value at the beginning of year 2 is the same as the book value at the end of year 1, which is $1,800. For the depreciation expense for year 2, we use our formula, and we have $1,800, the book value at the beginning of year 2, times the depreciation rate of 0.40, which calculates to $720. The accumulated depreciation at the end of year 2 will be the depreciation expense for year 1 plus the depreciation expense for year 2. So $1,200 plus $720, which equals $1,920. And the book value at the end of year 2 is the original cost of the asset minus the accumulated depreciation at the end of the year. So we have $3,000 minus the accumulated depreciation at the end of year 2, $1,970, which equals $1,080. And year 2 is complete. And here are the calculations and numbers for year 3. Now for end of year 4. And keep in mind that the book value at the end of the year cannot go below the salvage value of $500. For column 2, this is the $3,000 original cost of the asset. The accumulated depreciation at the beginning of year 4 is the same as the accumulated depreciation at the end of year 3, which is $2,352. The book value at the beginning of year 4 is the same as the book value at the end of year 3, which is $648. For the depreciation expense for year 4, we use our formula, and we have $648, the book value at the beginning of year 4, times the depreciation rate of 0.40, which calculates to $259.20. We're going to continue, but hopefully you see the problem here. The accumulated depreciation at the end of year 4 will be the depreciation expense for year 1, year 2, year 3, and year 4, which equals $2,611.20. And the book value at the end of year 4 is the original cost of the asset minus the accumulated depreciation at the end of year. So we have $3,000 minus the accumulated depreciation at the end of year 4, $2,611.20, which equals $388.80, and year 4 is complete. But it's wrong. Remember, we cannot have a book value go below the salvage value of the asset, which in this case is $500. So we need to make some changes to end of year 4 so that we have a final book value of $500. The easiest way to do this is to clear the last 3 columns for year 4. We can put $500 in for the book value at the end of year 4 because we know that this is where the cutoff needs to be. So we need to calculate the depreciation expense for year 4. We can't use our depreciation expense formula for this. As we saw, this gets us below the $500 ending book value. What we need to do is take the book value at the end of the previous year, year 3, and subtract $500, the ending book value we need to be at. So we have $648 minus $500, which equals $148 as the depreciation expense for year 4. And now we can calculate the accumulated depreciation, which is the depreciation expense for each of the years added up. And doing so, we get $2,500, which is what we need to be at. Since the asset has a useful life of 5 years, we do need to fill that in. But since we reach a salvage value in year 4, we cannot claim any depreciation for year 5. So that will be $0, and we carry down the accumulated depreciation and the book value columns, and our depreciation schedule is complete. And here is another example with an original cost of $22,000, a useful life of 8 years, and a salvage value of $3,000. All right, my friends, hopefully you got something out of this video. I do have more videos right there for you. Till next time, I am out of here.